Hi, I'm Todd Schoenberger, Managing Director of LandColt Trading, and this is another edition of Wall Street Lingo. I'm here today to talk about Operation Twist and monetary policy. Federal Reserve just today released their most recent monetary policy change for the U.S. economy, and they dubbed it Operation Twist. What does that mean? They're actually taking bonds out of their entire portfolio, just like you may own some bonds, and they're actually going to reinvest those proceeds when they come due to buy longer-term bonds. The idea there is that when you buy a bond, the inverse relationship happens. Clearly, bond prices go up, but interest rates will go down. So therefore, the Federal Reserve feels that if they do the twist, they could take those shorter-term proceeds, push them out to the longer-term maturities, and therefore push interest rates even lower. Therefore, you're going to look at cheaper mortgage rates, auto loan rates, boat rates, any consumer-related interest rate. That's great news for the U.S. economy, but it also alleviates any pressure on the central bank, the Federal Reserve, because therefore they're no longer having to print any more money. They don't have to worry about congressional pushback, and therefore they can actually have something that has already historically happened, and it was back during 1961. So the hope is right now interest rates for the long term will remain cheaper, and if they do, consumers will again begin to borrow and therefore continue to spend. And if they do spend, hopefully that would trickle down to higher rates of new hiring. So from there, I'm Todd Schoenberger, Managing Director of LandColt Trading, and this is Wall Street Lingo. Thank you.